Good morning. For Traders Exclusive, this is George Kachuk with RCM Wealth Advisors reporting to you from the CME Group trading floor in Chicago. I'd like to take a look at the equity markets this morning. Equity markets, the selling pressure is intensifying. We started this last leg of the uptrend October 2nd. Pretty good buy signal. The markets have trended up very strongly. However, last week, about midweek, things changed for the worse. We had some heavy distribution days on Thursday and Friday. A lot of selling pressure, and also a lot of the leaders were getting hit. Now, this of course doesn't, few days doesn't make a trend change, but it's something to look out for. Generally speaking, the long-term trend is still up. However, in the short term here, the uptrend is definitely under pressure. So let's take a look what's going on. The S&P 500, it broke down through its 200-day moving average at the end of last week. There's also right above that 2020 level, which was the September high. If it breaks down through there, pretty much the next support level will be 2,000, and perhaps further down we might see 1950. The NASDAQ also broke down below its 200-day moving average, also broke below the 4960, which was its September high. So right now we're above that 4920 level, flirting with that. That 4920 is the level where it was about October 22nd. Where it gapped up on October 23rd, a big gap up move, so it's filling that gap. If it breaks down here, we might see 4,900, and if we go through 4,900, we could go to 4,800 very quickly. So a lot of selling pressure going on. Now, if we look at the sectors, at the S&P sectors, there's only two sectors that are still above its 200-day moving average, and that's the technology sector. We look at the XLK and the consumer discretionary, the XLY. And the XLK, that coincides with the NASDAQ 100, also still above its 200-day moving average. The financials, XLF is below its 200-day moving average. However, the one positive is bank stocks. If you look at the KBE or the KRE, those are the ETFs for big banks and regional banks, those are still above its 200-day moving average. Those are about the only positives going on in this market. Even although a lot of technology leaders were also getting hit. We saw Facebook getting hit pretty hard, Amazon. Those are some of the leaders getting hit. Apple's been down for quite a while. Google's still hanging up pretty good. So that kind of tells you what's going on in this market. A lot of pressure. Healthcare is getting hit. Also, and consumer staples also below its 200-day moving average. And of course, the laggard sectors are still lagging. Those are the materials, XLB, utilities, XLU, and energy, XLE. Although this morning, that's one of the things that's having a little bounce in this market. So to sum this all up is, this is not a time to start getting aggressively long. It's not necessarily a time to get short. It's just a time to step back. Let's see what happens here in this market. And again, if we use the 2011 market correction as sort of a guideline, it didn't look like we're going to have this third leg down as we did back then. But now it looks like we sure enough may have that third leg down. So we might see a little bit more selling over the next few days. So just mind your stops, be cautious, don't get too long. Not a reason to go short just yet. And as always, that price and volume be your guide. This is George Kachuk with RCM Wealth Advisors reporting to you from the CME Group trading floor in Chicago.